Okay, so this is another extremely important topic regardless of how much time I spend on it. Now, I do want to kind of keep it short, but at the same time, I don't want to, like miss over anything that's important. And because this is really an important thing. Like, this is single-handedly the thing that kept me for trading for so long, because this is the one thing that I did do right once I got started. Is I luckily actually came into some information that taught me the importance of risk. So because I, did have that risk mentality as I was starting to get, understand the markets and starting to learn how to trade and starting to develop my strategy, that I was able to keep trading, and I was able to trade again the next day and the next day, which got me to this point until I finally figured it out and finally, conquered my trading demons and all of that stuff, and I was able to be successful. All right. So as we know, risk management is definitely a necessity for a solid trading plan. This is why I'm talking about it, and I gave it its own section before we get to the strategy. Now, obviously, this course gives you the strategy that lays out the foundation, but what it doesn't do is it doesn't tell you how much money you should be risking per trade. Okay, so with that, we're going to get into the first thing that we're going to talk about, which is margin to equity, right? And all that really means is how much of your available capital, the money that's in your trading account, are you risking per trade, right? So with a good solid risk management plan, you want to have a cap on how much money you're risking per day, or how much money you're risking per trade, how much money you're risking per day. And I would highly suggest that you have a cap on how much money you're risking per week, right? You can even take it out to month, or however you want to do that, right? So what this does is not about the money necessarily. It's more so it's a protection for you. If you find yourself trading outside of what you should be doing, or you just out of your mind trading, this protects you, because usually when you're trading outside of what you should be doing, you don't realize it in a moment. It's always once the dust settles and everything's clear, it's like you go back and you see your trading is like, what was I doing? So what your risk management does, what your risk plan does, is it protects you from those moments when you think you're trading well, but you're actually not trading well, and you're trading outside of yourself, and you're not sticking to your strategy as well as you think that you are, or you're not sticking to your plan as well as you think that you are. Your energy is off and you don't realize it in a moment. Your risk management plan protects you from that. And for some reason, there's still traders that don't understand this concept or didn't get this memo. So I want to make sure you do get the memo. You can't say that you didn't get the memo, so you're not out there trading without a stop loss. Whether that's if you want to have a hard stop loss, this is the one that I recommend, having a hard stop loss, because it doesn't matter if it's a hard or mental. Price is going to trade down there whether you want it to or not. It doesn't matter. Market makers are not looking at your particular stop loss. If the price got down there, it was going to get down there with or without your hard stop loss. So I would highly recommend that you use a hard stop loss. Again, we're trying to protect ourselves. If you just use a mental stop loss, it makes it more likely that you will see price trade down there and you won't pull the trigger to take yourself out of the trade, because that you just you make yourself vulnerable to your own emotions, to where that you would end up taking a bigger loss than you need to. Right? You place that hard stop loss there. Now you got to take another action to remove that stop loss. It just gives you another step and that extra layer of protection when you are wrong, because you will be wrong sometimes, as trading. Losses are just part of this game, okay? So best practices tells us that we want to make sure that we want to have a good reward to risk ratio. And I'm using that way on purpose, right? A lot of times you'll hear people say risk to reward, but we want to be positive. We want to lead with positivity. We want to make sure that we're trying to make more money than we're risking on each trade, okay? So this strategy, by default, the base of it is a 3-to-1. We're going for a 3-to-1 with this strategy. Now, you can adjust that as much as you want to, but what you don't want to do is you don't want to go below a 1-to-1, okay? Now, there are certain instances when you have a strategy that has a very high win rate, where they have a less than 1-to-1, reward to risk, but when you're starting out, that's not what's important. As you get good, as you become a good solid trader and you're consistent and all that good stuff, then you can start playing around with the numbers, and you can start playing around with different strategies, and you can actually risk more than you stand to make, just because you're going to win more and all that stuff. But let's get good first, okay? So in this strategy, we're going for a 3-to-1, and with that 3-to-1, with the strategy, You should be able to get at least a 60% win rate. Okay, so with the strategy, using my own edge and my own personal strengths and all that good stuff, what makes more sense to me, I've been able to achieve a 92% win rate. And actually, we can go look at that. So let's go ahead and look at let me go ahead and switch over to the monitor. All right, so you can see this is my trader view here. When I share these trades, I share my trades on TradingView every single day when I do make trades with the Leeloo account. So what I want to point out here is from October, this is when I started using the strategy that I'm talking about in this course. I started using it sometime, it wasn't October 1st, but it was sometime in October. So I just went from October 1st just to keep it simple because I don't remember the exact date when I fully started using this strategy. But from October 1st, I was able to, with the strategy and imperfect trading, I was not trading well during this whole time. Like there were some things that I needed to work out. There were some things that I needed, and I had to needed to prove some things within myself. So this was also part of my self-improvement journey, and also me trying to iron out some things. There's some things that I needed to improve within the strategy itself. So anyway, with all of that being said, I was still able to get a 92.9% win rate with this strategy. Out of 169 trades, I was able to win 157 of them, and I had 11 of them that were losses. And this one, which I'm not even sure about, this 0.6 is a scratch trade. I do have one more on here, another loss, which, okay, that other loss maybe take it down to 91, fine. That I didn't put in the trader view simply because it was just another one of those. It was a whole thing that I could talk about another day, but with that, you can see like my largest loss was bigger than my largest gains, and I was able to still get, become profitable. This isn't by ticks. I don't want us to get caught up on the dollar amount. I want us to really focus on the quality of the trades and not the quantity of the trades, if that makes sense, right? So the only reason I was able to yield those kind of results is because I use my own edge and I use my own strengths. But in general, this strategy should get at least a 60% win rate. So you should be able to achieve at least a 60% win rate. And it won't be, don't expect these same kind of numbers. These are specifically my numbers. You're not going to get these same kind of numbers. You can do better or you can do worse. So I'm only showing that to show you that once you use the power of using your edge, that is one of the powers of using your edge. The sky is actually the limit with this strategy. So with all that being said, we don't want to get caught up on the monetary value of our results. We want to more so focus on how well we followed the strategy, how well we stuck to our plan, how consistent we were, all of that stuff. That's what's going to give us our success over a long period of time. Don't really focus about the monetary results for right now. The monetary results will take care of themselves. All right, so let's get back to risk. So with that margin of equity that I mentioned before, the industry standard, of course, what everybody likes to talk about, you want to risk less than 5% of the capital that you have in your account. Now, while I would recommend that, especially if you're just starting out, just for that protection, like I mentioned before, it's not necessarily required to risk that little, but it is a good thing to risk that little when you're starting out, because you want to be able to trade the next day, right? And the more chances that you can give yourself to have those big wins and have those winning trades, the more likely it is that you'll be able to do this for a long period of time, right? So with that, let's talk about the minimum amount of capital that I would recommend for this strategy. And the minimum amount is $7,500, okay? This is after a lot of consideration and thought. Now that gives you plenty of room to the downside. Now, if you don't have $7,500, you can get away with, I would say, $5,000, but I would recommend that be your absolute minimum, just $5,000. Now, with this strategy and staying disciplined to your margin to equity ratio and just being disciplined and consistent, you shouldn't ever have to worry about drawdown. The monetary value of your results are going to take care of themselves, right? Now, if you have an emotional attachment to money to where it's hard for you to just think of your risk in terms of dollars, let's say you start out with this, let's say you start out with a $10,000 account, and for every trade, you're going to just only risk $200. Now, that's going to give you plenty of room to, take losses and stay consistent without ever having to worry about blowing out your account. But if for whatever reason, you're just that emotionally attached to money, one method that you can use to make sure that you're not, getting emotionally triggered to where it works against you, and where you start, getting hesitant to pull the trigger and it starts affecting your discipline and your consistency, is you can use this method that I started using when I started trading, which is referring to your risk as an R. So whenever you're going over and you're looking at, okay, I see this position opening up, instead of saying, all right, I'm going to risk $200 on this trade, you can say your R equals however much money that you're going to risk per trade, which is $200. So your 1R equals 200, right? So you can say I'm only risking 1R on this strategy. That decreases the number, right? And that kind of takes you emotionally away from the monetary value of that risk, right? So let's go ahead and illustrate this. All right, so let's just say, for instance, I'm looking to take a trade. I see this shaping up right here, and I want to take a breakout trade here, okay? So I'm going to enter in here, and then I'm going to have my stop loss there. And let's just say, just for example purposes only, this is not this is not what it equals, but let's just say, just for example, that this is a $200 loss, right? So instead of saying that if price trades down here, I'm going to lose $200, instead of doing that, we don't even care about it. We don't want to see that. We can say I'm only going to lose 1R. Okay, so now we don't even have to worry about losing $200. We don't have to worry about losing 1R. So that just gives us a visual representation of, you know, what I was talking about, so we can actually see it. And what that does is just kind of plays with words, and, you know, gives you a little play on words so that you're not getting caught up on the monetary value of what you're losing. Now, of course, it's still going to be $200, but at least when you're looking at it, you're looking at it as a single number, as 1R, and it's not even a monetary value. So it becomes less of an emotional struggle for you if, you know, if you're having a hard time with that part of it. All right, so that's just a recommendation, but it just gives you another way of looking at your risk so that you're less likely to get emotionally triggered. And since we're on the topic of emotions, risk is really more about emotions than any number or whatever we put to it. You know, we can talk about all the numerical values and all of that stuff, but it's really about your emotions. You're going to take losses, but it's how you feel about it that makes the difference. If you're going to, you know, stop, if you're going to quit, or if you're going to, you know, continue to consistently pull your trigger and trade the strategy like you should, right? So these things that I'm telling you is to help you with your emotions, with the emotional side of it. Of course, we're not robots, so, you know, we can't be expected to trade without no emotions. It's not, you know, being emotionless, is how we deal with the emotions, right? So again, like everything that I talked about up to this point, all of these things help you deal with your emotions, understanding what your risk to reward ratio is, what your margin to equity ratio is. Understanding all of these things helps you with the emotional side, so that, you know, like, okay, I'm about to lose in this trade, but it's only, you know, it's like 1% of my available capital, so I'm not even worried about it. And I know that this strategy is a complete and full strategy, and that I know that all strategies work, just not all the time. I just got to keep going until the strategy works, right? And it's going to be okay as long as I stay consistent, as long as I stay disciplined, and as long as my focus is on the right thing, right? So I can keep going on and on about risk. I can talk about this for hours, but I don't want to make this portion of the course, I don't want to take up a whole lot of time on this section of the course just talking about risk. So I'm, you know, I just wanted to highlight those key points. So let's go ahead and let's move to what we all came here for. I know this is what you couldn't wait to get to. Let's go ahead and talk about the strategy.